Okay, so for chapter 12, we're going to be getting into accruals and deferral concepts. And really, this all relates back to chapter 5, which back in chapter 5, we had the concept of the adjusting entries. So one of the things you might want to do is to, as you're doing this chapter, also go back and review the chapter 5 audio PowerPoint, as it basically contains the same concepts of this idea of accruals and deferrals and adjusting entries. So in terms of looking at this concept of the accrual basis of accounting, the idea is we start with the question of when is revenue recognized. And revenue is basically recognized when it is earned. Notice it says when earned, not necessarily when cash is received. Now, yes, you could recognize revenue when you receive the cash, but you don't have to. And that's the key with accrual accounting, is typically you earned it, but you do not have the cash just yet. And some examples are obviously revenue is recognized at the, when the sale is complete. If you drive through a McDonald's drive-through, you order your meal, by the time you pick it up, the sale's complete, McDonald's has earned their revenue. That's the basic idea. Now, once you take care of the revenue side of the equation, now you look at the expenses. And expenses are recognized when they are incurred or used. Again, look at this thing, not necessarily when cash is paid. So again, hopefully you're kind of picking up on that cash isn't a driver to determine when revenues and expenses are recognized. And basically the idea here is you recognize revenues when earned, you recognize expenses when they're incurred, and you typically want to assign those expenses to the accounting period in which it helped to earn that revenue. That's typically called matching. That's the idea that's called the matching principle, but you try to match the expenses and the revenues. And lots of times there's the saying that you say you let the expenses follow the revenues, okay? So, if you've earned all your revenues in for the year 2015, you want to make sure you put all the expenses in 2015 that help to generate that revenue. Okay, so think of matching principle. You try to match the revenues with the expenses. So based on some of the accounts we've been using here, you might have to do an adjustment for inventory. And obviously an account that you might use for inventory in the ledger is called inventory. In terms of the accounts we use to buy inventory, if you recall from your previous chapters, we had purchases account to actually buy the inventory, and of course you have your sales revenue account when you sell the inventory. So you'll notice that at some point in time this inventory will be going up and down, and of course you've got your purchases and your sales are basically separate accounts. So we have to figure out a way to make sure how to, number one, expense this inventory, and how to also update that inventory in your ledger. And so the account that we're going to be using is this account called Income Summary. We're going to use that to basically adjust the inventory balance as it goes up and it goes down, and that's going to be one of our adjustments for the inventory account. So one of the first things to do is you have to replace, get rid of that inventory out of that inventory account to move in the new inventory. And so, if you kind of look at a T account of your inventory, and in that T account, obviously, if you have a debit balance of $52,000, if you want to move that out, you're going to have to credit that balance or that account for $52,000 if that's the amount. So you notice in this slide, they are indeed crediting inventory to move out that beginning balance, and they're going to go ahead and put it over here into Income Summary temporarily, just to, so you have an offset for your debits and your credits. And then of course, once you've got the beginning inventory moved out, you put the ending inventory in next. And again, if I go back to my T account and you go back to inventory, obviously you're going to put $47,000 into that debit, and then of course you're going to have to offset that to something else, and that offset credit will go to, of course, Income Summary. So as you can see, here's your putting, this will be the ending balance of inventory. You're putting that into the inventory account, and then here's your offset to income summary. You're putting that in the credit side of $47,000. Now, you could also have adjustments for accrued and prepaid expense items. And of course, we have seen just about all of the, or not the accrued, but we've seen the prepaid items. We saw all of those back in Chapter 5. So again, please review the Chapter 5 PowerPoint, because I believe that will help you and assist you with some of the exercises in Chapter 12 as well. Okay, so one particular adjustment that you're going to have in accrual accounting is you may have to estimate some of your customers who may not pay you. So typically, if you have an account sale, you would debit accounts receivable and you would credit, of course, your sales revenue. Now, the problem here is sometimes you might have a customer that goes bankrupt or who can't pay you. And that does happen. So because of time issues, FASB and GAAP says basically what you have to do is for all of your credit sales, and this is for the month, for the year, for the period, you have to actually estimate or predict how much of that is not going to be collected. And some of that may not happen until later periods, but you have to come up with the estimate now. And so this is going to be an adjusting entry. And there's several different methods out there, but we'll just use a simple percentage number to calculate our estimate. And basically what we're doing is we're going to be debiting an expense account. We're going to call it Uncollectible Accounts expense. And then the offset is going to go to a contra asset account called allowance for uncollectible accounts. So this is a new adjustment. Again, you're making an estimate of your credit customers who will not pay you. And of course, this is adjusting entry. This is the matching principle, because the rule says if you have all these revenues obtained in a certain period, this technically, when a customer doesn't pay you, is technically considered an expense or a loss, and that needs to be matched up in that same period as that revenue. So it's also the matching principle as well. So like I said earlier, we're using in this chapter, or in this book, we're going to be using, it's called the percentage of net credit sales method. It's pretty simple. You simply just take a percentage and you multiply by the credit sales, and that's going to equal your estimate, and that'll be your adjusting entry. So in this example, let's say you had 0.8% of net credit sales are going to be uncollectible. So to do the adjusting entry, if you got net credit sales of 100,000, you're going to multiply those by 0.008. You're going to get $800. That $800 represents your estimate. So your adjusting entry will be uncollectible accounts expense. You're going to debit that for $800, and then you're going to credit an account called allowance for uncollectible accounts for $800, and that's your adjusting entry. This allowance account, and you can read about in the book, is basically a contra asset that is used to basically write down your receivables on your balance sheet. Okay, so to talk about this allowance for uncollectible accounts or allowance for doubtful accounts, I already told you this is a contra asset, and the way it appears in the balance sheet is as follows. Now, this is a different number from the previous slide, so I don't want you to get confused by that, but the way this was, let's assume that our allowance account has $1,050 in it, okay? What you do is you take the accounts receivable, you subtract out the allowance account to get what's called your net receivable. So again, the way this allowance for uncollectible accounts or allowance for doubtful accounts shows up on your balance sheet, it's a contra asset, so therefore it's going to reduce your assets, and therefore in this case AR is an asset. You subtract out the allowance, you're basically saying your net receivable would be that amount. Now, this was going back to 2 slides previously when we came up with that $800 adjustment. Again, you can see the T account wise, you're debiting $800 for your uncollectible accounts expense, and then you're crediting your allowance for doubtful accounts. And that's basically all you do. So again, the property, plant, and equipment, these are also referred to, or I refer to these as prepaid expenses. but the idea is they last longer than 1 year, so they're kind of like longer term types of prepaid expenses. And the adjusting entry that we're going to be using obviously is depreciation. So again, review the chapter 5, the chapter in chapter 5 on some of these. I believe the method that we're doing is straight line method, where you take cost minus salvage value, okay, and you divide that by the estimated life of the asset, and that's going to be your depreciation expense adjustment. Okay, you have some more types of accruals you're going to see in some of the problems in this chapter. You can have accrued salaries, which basically means these are incurred, all these are incurred, but they're not paid yet. Okay, so they're all incurred, but they're not paid yet. You could have accrued salaries, you owe these, you owe taxes. You could also interest on money that you borrow. That money typically exists because of a note payable. So if you're going to accrue salaries, typically you're going to be debiting a salaries expense account and crediting a salaries payable account. Debit $1,200, credit $1,200. That's all you do. You might have to do some tax accruals, and they have to give you the tax rate that they're multiplying that by. And so if it's Social Security, if it's 0.062, you multiply by the payroll. If it's Medicare, it's 0.0145, multiply by that. You add it up. This is basically the tax amount that you owe to the government. And of course, when you go ahead and do your adjusting entry on your payroll tax expense, you have to debit an expense account. And of course, you're going to have a Social Security tax payable and a Medicare tax payable as your liabilities. Okay, so you could also have some accrued expenses on a note. And of course, this will be called interest. And so typically the idea is the amount that's been borrowed is called what we call the principal amount. We have an interest rate, and then of course we have time periods. So I call it PRT. We'll take the principal amount of the loan, we're going to multiply it by the interest rate, and then multiply that by the time period, and that's going to be the interest that's going to be accrued on the note. On this one it says December 1st, they issued a 2-month note for $2,000 with annual interest of 12%. It says Whiteside will pay the interest when the note matures on February 1st, 2014. So you're going to have a problem here for the year 2013. At least 1 month you're going to owe some interest, and so you have this time period you're going to have to do an interest accrual for the year 2013 when you get to December 31st. So again, here's our calculation, and I like to do this a little bit differently. So up here I'm going to write how I'd write this out. I would take the principal, which is $2,000, multiply that by the interest rate, and because the interest rates are always annual interest rates in the accounting problem, interest rate's 0.12, I like to divide that by 12 for 12 months in a year, and that tells you that that's my interest rate per month. And so 0.12 divided by 12 obviously is 1. And then I'm going to multiply that by 1 month, because our time period here is December 1st through December 31st. That's how they get this 1 month. And that's going to give me $20 of interest that I owe, okay, after 1 month. So the actual adjusting entry would then be, you're going to have interest expense, and you're probably going to credit an interest payable for $20. And of course, in T-account format, this is what they're showing you: debit interest expense, credit interest payable for the $20. And these are review types of adjustments. We've already seen several of these, but yeah, you know, supplies is called a prepaid expense. You could have prepaid insurance, you could have prepaid rent, prepaid interest. But these first two are the most common ones that you're going to see most likely show up on a quiz or an exam. Now, accrued income, again, income is going to be income that is, down here I'm going to circle this, it's earned, but it's not been recorded, so therefore you have not yet received the cash. You don't have the money yet, but you have earned it, and because you've earned it, you have to go ahead and put it into your financial statements. So in this example, we could have some accrued interest on a note. This is going to be interest income. We're still going to have the PRT idea, principal rate time, because it's still interest. And in this case, it looks like it's a $1,200 loan. The interest rate is 15%. So what I do is I take the $1,200, I take that 15%, divide by 12, and then it looks like this is going to be for November and December, because even though it's a 4-month loan, most likely this is that the end of the period is December. So then you'd multiply that by 2 months to get how much interest you've actually earned. So here's the official calculation. Again, down here at the bottom, they're showing you the time period, November through December, 2 months. But notice, I do the same thing. In this case, I guess it's $1,200. It's 0.15 divided by 12 times 2 months will give you the exact same number, which is $30. So then you're saying, what would be my adjusting entry? Well, you're going to debit a receivable, interest receivable, and you're going to credit interest income or interest revenue. And of course, I just kind of gave it away, but that's kind of like, okay, what account are you going to debit? What account are you going to credit? And again, you're going to do some sort of receivable, most likely interest receivable, and then you're going to have a credit to some sort of revenue account. So we'll just say interest revenue, or you could even say interest income. And then here you've got it. You've got your interest receivable, and then here's your interest income. Now, another special type of adjustment deals with what they call unearned income, which is basically where you've actually received the cash before you've actually earned it. Okay, and here's some examples. Subscriptions, rental income is a big one. You could receive rent in advance, legal fees, architect, and so forth. But all you gotta do is read the problem. They're gonna tell you what's unearned, and then you just have to figure out what's earned. And the other thing about the unearned revenue is actually considered a liability because you actually have what they call a performance obligation. You owe something. You may not owe money, but you might owe a service. So unearned anything is actually a liability until you've actually earned it. So if you're filling out a worksheet, and they like to do a lot of worksheets in here, notice you've got a trial balance column. You have a column to put all of your adjusting entries in, your adjustments in. And then once you've made your adjustments, you take everything from the trial balance, and then you're going to update these based on these adjustments to get your adjusted trial balance. So a lot of these accounts over here would change depending on if you had any adjustments. And then once you've done that, then you can start figuring out, okay, what's your income statement, what's your net income, and then you can also then do your balance sheet.